Welcome. Today, we're diving deep into the financial engine of one of the world's most watched companies. Based on the fiscal year 2025 public 10K filings, we will break down exactly how Tesla generated its $94.83 billion in revenue and what these numbers tell us about the company's strategic direction. Tesla's business is built on three primary revenue engines. While automotive remains the dominant core at 73%, the energy and services segments now each account for roughly 13.5%. This composition shows a company that is rapidly diversifying its income streams beyond just selling electric vehicles. Let's first examine the automotive segment, which still represents the lion's share of the business. This includes the high-volume Model 3 and Y, the premium Model S and X, and the expanding presence of the Cybertruck in the global market. Looking closer at automotive, we see three components. $67.07 billion comes from direct vehicle sales, which saw an 8% year-over-year decline due to intense competition and pricing adjustments. However, regulatory credits contributed $2.07 billion, a critical figure because these credits carry nearly a 100% profit margin, providing a vital boost to net income alongside the leasing business. Now, let's pivot to the fastest growing part of Tesla, energy generation and storage. In 2025, this segment reached $12.77 billion in revenue, representing a massive 27% increase over the previous year, driven by the deployment of 46.7 gigawatt-hours of energy storage. This growth is powered by products like the Megapack for utilities, the Powerwall for homes, and various solar solutions. Most notably, the scaling of the Lathrop Megafactory has optimized production efficiency, driving gross margins in this segment to approximately 30%. The third pillar is services and other, which generated nearly $13 billion last year. With a 15% year-over-year growth rate, this segment is successfully transitioning from a cost center focused on support into a legitimate profit center as the global fleet of Tesla vehicles expands. Revenue here is highly diversified, ranging from supercharging fees for both Tesla and non-Tesla owners to real-time insurance premiums and after-sales parts. Crucially, it also includes high-margin software income from FSD subscriptions and one-time vehicle upgrades. Putting it all together for FY 2025, the total revenue stands at $94.83 billion. While this represents a slight 2.9% dip overall, the underlying mix reveals a significant shift in where the money is coming from. This chart highlights the strategic divergence we are seeing. While core vehicle sales faced an 8% decline due to pricing pressure, the 27% surge in energy and 15% growth in services signal that Tesla's growth story is evolving beyond the showroom floor. To visualize the scale, out of the $94.83 billion total, $67 billion is attributed to auto sales, while energy and services are now neck and neck at nearly $13 billion each, with regulatory credits rounding out the mix. However, this transition hasn't been without its challenges. Automotive gross margins dropped to around 13% in 2025, a direct result of aggressive price cuts intended to defend market share against a rising tide of global competitors. The margin shift is the most important story here. The 30% margins in the energy sector are starting to offset the pressure on the automotive side. When you combine this with the pure 100% profit from regulatory credits, the company's overall profitability profile is undergoing a massive transformation. Let's emphasize the regulatory credit advantage. Although they only represent 2% of total revenue, that $2.07 billion is essentially pure profit. This capital is what funds Tesla's massive R&D and capital expenditures, which are expected to exceed $20 billion in 2026. Beyond physical products, there is a hidden revenue layer, software. FSD subscriptions and performance boosts allow Tesla to generate recurring, high-margin revenue on top of every vehicle already sold, decoupling profit from the physical delivery of cars. This creates a powerful flywheel effect. Every vehicle sold increases the installed base, which in turn drives supercharger usage and insurance enrollment, eventually turning the entire service ecosystem into a consistent profit generator. Tesla is clearly betting big on energy. By scaling the Lathrop Megafactory and achieving record deployments of 46.7 GWh, they have made this the fastest growing and one of the highest margin segments in the entire company. To summarize the key analytical insights, we see a clear margin shift where energy offsets auto pressure, a strategic dependency on regulatory credits to fund future growth, and a service ecosystem that turns a one-time sale into a long-term recurring revenue stream. When we compare the revenue mix today versus previous years, the diversification is undeniable. Tesla is evolving from a pure-play automaker into a broader energy and technology conglomerate, with non-automotive sales now representing 27% of the business. In conclusion, despite a 2.9% decline in total revenue to $94.83 billion, the underlying pillars of energy and services are providing the momentum needed to offset automotive pricing pressures. Tesla's future growth is no longer tied to just one engine. Thank you.